Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Welcome back. In this video, we continue our discussion on over-leveraged oil and gas firms by looking at production decline, safety risks, and the long-term impact of reduced investment. Shareholders want cash now, not big drilling plans. Even if a company has a little cash left over, they face pressure from the people who own their stock. Investors are tired of waiting for long-term growth. They want to see dividends and share buybacks right now. In the past, companies would drill as much as possible to increase their size. Today, the market punishes firms that spend money on growth without showing immediate profits. This return of capital trend is a double-edged sword. While it's great for a quick payday, it can starve a company of the money it needs to keep its assets in good shape. For a firm already buried in debt, trying to please shareholders while also paying the bank means there is zero room for error. If they stop spending on their core business for too long, they might find they have no business left to run. The hidden costs of underinvestment: production, safety, and long-term value. When an oil company stops spending, the effects aren't always visible right away. It's like skipping the oil change on your car. It runs fine today, but you are asking for trouble down the road. In the oil and gas world, underinvestment shows up in declining production and aging gear. These firms are effectively trading their future value for a little bit of breathing room today. Decline rates are real. Less drilling can mean less output later. Oil wells don't produce at the same level forever. In fact, many modern shale wells see their production drop sharply after the first year. To keep the total amount of oil flowing steady, a company has to keep drilling new wells. If an over-leveraged firm cuts its drilling budget to pay off a loan, its total production will naturally start to fall. This isn't just a problem for one company. If several large players all stop investing at the same time, the total supply of oil in a region can drop. When supply goes down and demand stays the same, prices usually go up. This creates a strange situation where high debt levels at certain companies can actually lead to higher prices at the pump for everyone else. Maintenance and safety get squeezed first. It is much easier to delay a paint job or a pipe inspection than it is to skip a debt payment. Over-leveraged firms often defer maintenance to save cash. This might work for a few months, but it eventually leads to equipment failure, leaks, or unplanned outages. These problems are far more expensive to fix after they happen than they are to prevent. Safety is another area where tight budgets create stress. While most operators try to keep high standards, a firm with no cash has less room for top-tier training or the latest monitoring technology. Underinvestment eventually leads to a loss of value as pipelines rust and wells become unproductive, leaving the company with a skeleton of what it once was. How to spot an over-leveraged oil and gas firm, and what to do with that info. You don't need a finance degree to see the warning signs of a company in trouble. It is simply about looking at where their money goes. While this isn't financial advice, understanding these signals helps you separate the strong players from the ones just trying to keep their heads above water. A quick due diligence checklist: numbers and signals to watch. High net debt to EBITDA. The debt is likely a heavy burden when this stays elevated. Big maturities. Large loans coming due in the near term. Rising interest expense. Paying more in interest than last year. Negative free cash flow. Spending more than they make to stay alive. Shrinking capex. Capital spending below what is needed to maintain production. Frequent asset sales. Constant selling of non-core assets to pay the bills. Weak hedging. Little protection against a drop in oil prices. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.